adjusted income statement. Here is the income statement, and it's organized fairly simply with the income of all this income related to the farm. This is a net farm income statement, so we're only looking at farm income. We don't include off-farm income. And then these are all the expenses for the farm. You see hired labor. Usually owner labor is, I mean, not usually, but owner labor is not included here. That will come out as a residual out of net farm income. So then on this side you can see the adjustments that we just talked about, accounts receivable, inventory adjustments, and then expense adjustments. So supplies, which I incorrectly put in the top category, supplies on hand, adjustments for investment in growing crops, accounts payable. And depreciation stays the same under both, so it's the depreciation value. That gives you your gross farm expenses, and you take that from the gross farm revenue and get your net farm income from operations. And then if there's any sales or gains from capital assets, they're included, capital gains and losses, and to give you net farm income. So there may be some questions on capital assets. This is a little bit beyond what we're able to talk about today, but the main thing to note is you get an adjusted gross farm revenue and adjusted gross farm expense to give you a net farm income. Okay. What do we see on the net farm income? There's quite a few ratios that you can learn from, use to learn from your net farm income statement. Just going to mention a couple. The operating ratio compares the cash operating expense, so total cash operating expense divided by gross farm revenue. And what it does is measure the percent of gross farm income it takes to cover farm expenses. It pretty much is just a measurement of how much cash is involved in how much of the gross farm income is involved in covering the cash operating expenses. It gives an indication of the, I guess, the intensity of the operation as far as cash needs. And another one, an interesting one, is net return on capital. And it takes the net farm income and then adds back the interest paid, because that's a return to investment, adds that back into the total and takes out an allowance for labor, the owner's labor, and then that resulting figure is divided by average capital investment or average asset value. And what that does is give you the rate of return on assets. And you can kind of compare that to a rate of return you might get if your equity was invested somewhere else, or your total asset value was invested somewhere else. Not that you'd want to change, but it just gives you a comparison. And you can do the same thing with just equity or interest expense and other ratios. But interesting information you can get off your income statement. But the most important really is the net farm income and profitability measures you can get from the income statement from net farm income. The next statement we're going to look at is the cash flow statement. This is what a cash flow statement looks like. Cash flow statements include, it's a different set of numbers than the numbers in the income statement. It looks the same because you have income and expense categories, but it's all cash that comes into the farm. So it includes Uncle John's, loans from Uncle John or loans from the bank. It includes off-farm income. It includes any kind of income coming into the farm, used by the farm, government payments, government programs, sales of crops, sales of livestock, and then all expenditures to do with the farm. So seed, fertilizer, you see the list there. And these can be this can be organized quarterly. Quite often they're organized monthly. And they can also be pro forma, or they can be looking forward, or they can be for past year's performance. And actually, you should compare your cash flow budget, which is usually looking forward, to your cash flow statement, which is usually looking backwards, and what actually happened cash flow-wise in the year. Another way of organizing this statement, and there's a group called the Farm Financial Task Force. They recommend organizing the cash flow, particularly the report of past activities, so the report of what happened in the past year. It's the same exact numbers, but they organize it different. They organize it by operating activities, so this is production, cash receipts from customers, cash paid. And then the second category is investing activities, so primarily purchases of equipment, sales of equipment, any kind of growth from that. And then investing, or the final cash flow category of financing activities. So this would be primarily proceeds from a loan or payments from loans. And the same numbers involved, just a different organization of the numbers. Most common is this arrangement of cash flow statement. This is sometimes required by lenders, and it's an interesting way of, you can get more other information from this form than you do the other form, although the same kind of information. Okay, so what's the cash flow tell us? Well, first of all, a business you can have a good, healthy balance sheet, and you can have your net income can show that you have high net income from your income statement, but that doesn't necessarily mean, if you haven't done your cash flow statement, that you can meet your upcoming cash obligations, or that you even know where those income flows came from in the last accounting period. So cash flow statement, it just, as I mentioned, includes other off-farm living expenses, non-farm income. It gives us a big picture of what cash flow looks like on the farm. And of course, if you're using a cash flow budget, it gives you the opportunity to arrange to meet your cash flow needs throughout the next year. So very important. And those first three statements, if you're going to apply for financing for land or business operation, they're always required these days. And back in the day when I started farming, my father-in-law pretty much turned in his balance sheets, and the rest was kind of on a handshake. But pretty much those days are gone, and a complete set of financial statements, if you're going to work with a commercial lender, are required. Okay, the final statement is the statement of owner equity. Not as often completed in agriculture, but yet the only way really to explain the change that takes place between beginning owner equity, which comes off the balance sheet, remember, and ending owner equity, which also comes off the balance sheet. So not all of the owner equity changes can be explained from information contained on the balance sheet, or on the balance sheets and on the income statements and cash flow statements. Owner equity can change due to change in net income generated from the business, but it can also change into withdrawals of equity taken away from the business, farm business, or perhaps contributions. These could be inheritances, for an example. Inheritance could definitely introduce assets into the business that weren't earned by the business. And then another is distributions, and distributions could include gifts, for instance. And then we recall we were talking about asset valuation. You could have a change in owner equity just simply by adjusting asset valuation, which is more of a paper transaction unless those assets are actually sold. So these, kind of like our beginning illustration, similar to a checkbook, but help explain what happens between the owner and beginning and ending owner equity. Here's what the form looks like, and you can see the different categories there. I won't take time to go through them each one, but they correspond with some of the transactions I just mentioned. So the statement of owner equity, what does it mean? It does explain your current investment equity in the farm and where it came from, changes from that in the last year. You know, a farm, as I mentioned in the beginning, regardless of size, regardless of the mixture of assets used to produce a product, is a business, and growth in equity is something that is important to farmers, should be important to farmers, because it helps provide the farm the ability to grow, and even if growth isn't necessarily important, to contribute back to the community, to provide for the continuation of the business beyond the current generation. There's a lot of things that are important, and sometimes profit's been you know, an evil thing from Wall Street, but really it's an important thing for our businesses and for our values, to be able to, for us to express our values in whatever way that we like to do that, whether it's you know, continuation of the farm or even charitable work, things like that. You need to generate profit in order to build equity in the farm. So this is a list of equity changes and why it changes, and this is the way you get off the statement of owner equity.